Welcome to our deep dive into the looming financial issue that's been making headlines lately, the auto loan bubble about to pop in 2023. Picture this: you're under 40, you've got a car, and you're part of a demographic that has seen a significant increase in vehicle-related debt. In fact, the average auto loan has surged by a staggering 41% since 2019, now hovering around the $24,000 mark. But what does this all mean? Why should you care? Well, we're looking at an auto loan bubble, a situation where the value of auto loans has inflated to potentially unsustainable levels. It's something that's not just affecting individuals, but could have far-reaching implications for the broader economy. As we peel back the layers of this complex issue, it's important to understand the potential impact on the economy and individuals alike. To comprehend the gravity of this situation, we first need to understand what an auto loan is and why its rise is alarming. An auto loan, in the simplest terms, is a sum of money that a person borrows to purchase a vehicle. The borrower then pays back this loan over a set period of time, with interest. Now, why is the rise in auto loans alarming? Well, there are a few reasons. First, we have seen a trend of lower interest rates over the past years. Lower interest rates mean cheaper loans, which in turn encourages more people to borrow money for vehicles. While this might seem like a good thing at first glance, it can lead to a situation where people are taking on more debt than they can manage. Second, the loan terms are getting longer. A decade ago, it was common for auto loans to be paid off in 4 to 5 years. Now, it's not unusual to see loan terms stretching to 7 years or even longer. Longer loan terms can result in more interest paid over the life of the loan, and they also increase the risk of borrowers ending up underwater on their loans, owing more than the vehicle is worth. Lastly, the cost of vehicles is increasing. With new technology and features being added to vehicles every year, the price tags are going up. This, combined with the other factors we discussed, is leading to a steep increase in auto loans. The average auto loan has risen by 41% since 2019 to $24,000, with Americans under the age of 40 seeing the largest increase in vehicle-related debt. This isn't just a number. It's a signal of a trend that could lead to a large number of people defaulting on their loans if circumstances change, like a rise in interest rates or a downturn in the economy. The increase in auto loans isn't just a number. It's a reflection of a bigger, potentially problematic trend. Now that we understand the rise in auto loans, it's time to delve into what happens when this bubble bursts. Let's begin by painting a picture. Imagine a balloon expanding, getting larger and larger. Suddenly, it can't take the pressure anymore, and it pops. That's what we're talking about when we say a bubble burst. In this case, the balloon is the auto loan industry, and the air filling it is the debt that's been piling up. So what happens when this auto loan bubble bursts? Well, one of the first things we'd likely see is a sharp increase in default rates. When people can't keep up with their loan repayments, they default. This essentially means that they've failed to meet the legal obligations of the loan. It's a lose-lose situation. The individual suffers and the lender suffers. But the impact doesn't stop there. Defaulting on loans also negatively impacts credit scores. A bad credit score can make it harder for individuals to get loans in the future, and not just auto loans. We're talking about home loans, personal loans, even small business loans. It can also affect the ability to rent homes or apartments, and in some cases, even job opportunities. The strain on the economy can't be overlooked either. The auto industry is a significant part of the economy. When people stop buying cars because they can't get loans, or they're too worried about their financial situation to make big purchases, it hurts the industry. And when one industry suffers, it can have a domino effect on others. To wrap it all up, it's not just about people not being able to buy cars. It's about the potential for increased financial instability, the strain on the economy, and the impact on future opportunities for individuals. The ripple effects of this bubble burst could be far-reaching, affecting not just auto loan borrowers, but the economy as a whole. As we wrap up our discussion on the auto loan bubble, it's clear that this is a situation that requires attention and understanding. We've delved into the rise of auto loans, particularly among Americans under the age of 40, and how the average loan has seen a staggering 41% increase since 2019. We've also explored the potential fallout of this bubble bursting, a scenario that could have far-reaching implications for not just borrowers, but the economy as a whole. The auto loan crisis isn't just a financial issue, it's a societal one too, affecting people's ability to commute, work, and live their lives. This is a complex issue, but by shedding light on it, we hope to help you navigate these tricky financial waters. We all have a role to play in understanding and addressing this crisis, and knowledge, as they say, is power. Thank you for joining us on this exploration of the auto loan bubble. Remember to subscribe for more content that helps make sense of complex financial issues. Stay informed, stay ahead.